A lot of students find irrecoverable debts quite a tricky topic. One of the key things to learn in this chapter is the double entry for each of the different adjustments that we need to make. So learning the double entry here is key. A debt is a receivable, it's a current asset. Okay, so it's that right to receive a future benefit. In other words, it's a receivable asset for the amount that our customers owe us for. Now, unfortunately, sometimes our receivables might not pay. Typically, in the situation where a company goes into liquidation, or if it's an individual sole trader, that they're declared bankrupt. In these situations, if we're not going to recover the money, we would refer to these as irrecoverable or bad debts. And what we mean by that is the accounting adjustment that we make to remove the receivable from the ledger. Remember, we can only recognize assets in the financial statements if we're going to get some kind of value from them. We've just said, well, the receivable isn't going to pay. We're not going to get any cash. Okay, so that asset is not worth anything. And this is an example of us applying the concept of prudence, which was covered in the earlier chapter 2. So if we know we're not going to get paid, what we need to do is write off the debt, and the double entry is written out here. What we do is we debit a bad and doubtful debt expense account. Okay, so that's an expense in the income statement. And we credit the receivables control account, okay, because that then removes the amount from the ledger altogether. Okay, it's very important that you realize that you don't actually reverse the original sale. Remember, when we made the sale, we made that sale in good faith and we have supplied goods or services, so it's not correct to reverse the sale. We treat this debt write-off as a separate entry, and that bad debt expense amount is usually included within administrative expenses that affect our net profit figure. Occasionally, it might be that you've written off a debt because you didn't think you were going to get paid, and then surprisingly the customer does actually pay. Again, you need to learn the double entry for this particular scenario, which is clearly to debit cash because we've received cash from our customer. The credit side of the entry then is going to credit the bad and doubtful debt expense account. In other words, that reverses the effect of the earlier write-off. Okay, so that's what we mean by irrecoverable or bad debts. There's another situation that we need to be aware of, though, and that's where we have concerns about the recoverability of some of our amounts due from customers, and we call these doubtful debts. Okay, so it might be that customers haven't necessarily gone into liquidation or gone bankrupt, but nevertheless, perhaps they're taking a very long time to pay. Perhaps we're struggling to get hold of them by telephone to ask them to pay our invoice. And so when it comes to year end and drawing up our financial statements, we have a real concern that the debt might not be paid. So in order to take a prudent approach to preparing our financial statements, what we do in these situations is create an allowance for doubtful debts. Okay, the allowance account is an account in the financial statement of financial position which reduces the value of, in this case, our receivable asset. The double entry then to create this allowance account is to debit the bad and doubtful debt expense account in the income statement. So that was the same as before when we wrote off the debt. But this time, instead of crediting receivables, what we do is we credit this allowance for doubtful debts account. And like I said, that's an account in the statement of financial position. Okay, by doing this, we haven't touched the receivables account. So the amount that we're owed still stays in the receivables control account. It still stays in the memorandum ledger. So our credit control department can continue to try and recover the amount that we're owed. Okay, so 3 lots of double entry there to learn. But having created this allowance, that's not necessarily the end of the story. Okay, having created this, there's two things that might happen. Firstly, it might be that the customer still doesn't pay, or the customer does pay. So we need to know what we do in each of those situations as well. We'll look at the first scenario first of all. Suppose we've created an allowance and we're now fairly certain that our customer isn't going to pay. What we want to do is write off the amount. Okay, so we're writing off the bad debt, but we need to be very, very careful, okay, because we've already created an allowance, so it isn't the same as the first illustration we did. The double entry in this case is to debit the allowance for doubtful debts and credit receivables. Okay, so by debiting the allowance, you've removed the allowance altogether because you no longer need it, the customer isn't going to pay, and you remove the debt altogether from your receivables, again because you know you're not going to pay it, and you don't want your staff to spend any more time trying to chase an amount that they're not going to recover. Okay, remember the expense was taken when we created the allowance. Okay, so we already took the expense earlier on. The second scenario, if our customer now pays us, having created an allowance, what do we want to do here? Okay, we've actually got to do two things here. Firstly, as normal, you would record the receipt of cash, so you're going to debit your cash account and credit receivables. So that really is just your normal double entry that you make whenever you receive cash from your customers. But having credited the receivables account, we don't want this allowance sitting in the ledgers as well. We've got to remove the allowance, so we debit it. And the credit side of the entry is to our bad and doubtful debt expense account again. In other words, removing the effect of the allowance. Okay? Because we've now received our cash, there's no expense associated with that. Now, what we talked about there with our allowances is something called a specific allowance. Okay, so that comes about when you go through your memorandum receivables ledger and you identify specific customer balances that you think are not going to be paid. Now, there's another type of allowance that a lot of businesses will set up, and that's a general allowance. And it's often used particularly in businesses which might have a large number of customer balances of a fairly low value. It's not worth the effort of going through every single customer balance line by line. In other words, what you can do is say, well, on average, a certain percentage of my debts sadly aren't going to get paid, so I'm going to just make a general allowance of that percentage. Most businesses are going to go about calculating it in a particular way. Okay, so again, you need to learn the order in which you do things. So we're going to learn this approach. First of all, you're going to deal with writing off your bad debts. Okay, that's the first thing to look for. And then secondly, you're going to identify whether you've got any specific allowances that you need to make. Then what you're going to do, remember our bad debt write-offs had the effect of crediting our receivables ledger. And when we created our specific allowance, that didn't affect our receivables ledger. However, we don't want to calculate a general allowance on amounts that we've also made a specific allowance for. So we deduct the value of the specific allowance and then calculate the general allowance on that percentage of the remaining or adjusted receivables figure. Having calculated the figure, the double entry is exactly the same as for the specific allowance. We debit the bad and doubtful debt expense and credit the allowance account in the statement of financial position.